Hello and welcome. This is Livewise The Pitch and I'm Sarah Allen. Today I'm joined by Mark Power, Head of Income Credit for Qualitas. Today we're going to be discussing all things private credit. Mark, welcome.
Thanks Sarah, delighted to be here.
So to begin with, what's the outlook for private credit globally?
Private credit's actually forecast to grow really strong over the course of the next few years. If you look at common market consensus, the view is that globally, the market will increase in size from US 1.5 trillion to 2.8 trillion in the period between 2022 and 2028. And whilst it's really strong growth, it's interesting to note that over the course of the past 12 months, that the number of funds actually being launched has actually decreased by 40%. So you'd say, well, that's kind of counter to the strong growth in the sector. But what we're finding is whilst the number of funds has actually reduced, the size of those funds has actually increased significantly. So it's increased by more than 28% in terms of the amount that those investors are actually contributing to new funds. So how that market's playing out is that those global investors are aligning themselves to a fewer number of managers, but committing more capital to those managers. Because what they've identified as the sector's matured are those managers that have got a really sound track record that are outperforming over a long period of time, and they're looking to attach themselves to that.
Okay, what do you think is driving this increased interest from investors to invest in private credit?
I think it's a function of essentially the risk-return equation in the asset class. And I often talk to it as you're almost cheating the risk-return curve here, because you're getting equity-style returns, but in the debt stack. So if you think about an institutional investor coming into the market, they can see Australia a great place to invest. They can see the structural gap that's occurred in the marketplace in terms of the retreat of the traditional financiers. And it's still an emerging market in Australia with strong return characteristics associated with it. So essentially those global investors can get the same sort of returns in Australia in what I describe as an unlevered fund, so with no back leverage, as compared to other parts of the globe where they're getting similar returns, but they're doing that with a whole lot of financial engineering in behind them.
Okay, and is there anything you think the market hasn't fully appreciated about the potential of private credit?
I think so, because it is still quite a new asset class here in Australia. So I think certainly one part of the equation that I don't think people have properly appreciated is the extent to which private real estate credit can provide through the cycle consistent returns. If you look at the market as a whole, we should be able to generate returns somewhere between 400 and 600 basis points over the 90-day swap rate. And because you're attached to the debt part of the capital stack rather than the equity part of the stack, you've always got first claims on cash flow coming out of the asset. You've always got first claims on realisation of funds coming out from the realisation of the asset as well. So it is very defensive. So for investors that are after that regular monthly distribution from an asset class which has got strong fundamentals supporting it, and you're in the debt stack, I don't know that investors fully appreciate it. They're getting it. It's certainly now, compared to say 12 months ago, there's a much better appreciation of that characteristic. But I think the market's still on a bit of a learning curve as far as that's concerned.
Is there anything that investors need to be mindful of when they're choosing to invest in this space?
I think it's really important that they attach themselves to a local manager. Real estate is very much, from a geographic point of view, a very local investment thesis. So you want to make sure that manager has strong connections and relationships with the counterparties that they're involved with, so the borrowers essentially. Very, very critical. The other piece is around the risk process of the manager. So it's real estate private credit, it's not a set and forget strategy. So it's got to be dynamically managed, and that's at the time of underwrite. So for an investor looking at a particular manager and looking at investing in this sector, they should really thoroughly unpick the risk underwriting process of any manager that they're actually looking at, to ensure that they're going through a really a really thorough due diligence process. And what I mean by that is at Qualitas, we consider ourselves to be unapologetically intrusive in terms of the amount of due diligence that we do on our borrowers, because we want to make sure that if we're bringing a loan into any of our funds, that we're very comfortable with the risk exposure at the time of underwrite. So that's one point from a risk mitigation side of things. The other side is once you actually bring that loan and underwrite that loan, once again, it's not set and forget. That loan's got to be dynamically managed. So, for instance, at Qualitas, we review every single one of our loans on a monthly basis to see if there's been any shifting of the risk profile of that loan. And if there has been deterioration in that loan, we then look to put risk mitigation strategies around that to ensure that it either improves, is restructured, or ultimately refinances. I think that the third piece I'll talk to as far as important for investors coming into these funds is the attraction of actually being able to invest alongside institutional investors. So if we think about Qualitas and the funds that we manage, the vast majority of that is institutional capital, and those investors are incredibly sophisticated. They do an enormous amount of due diligence on us as a business before placing funds for us to invest. And if other investors can invest in funds where they're sitting alongside those institutional investors, I think it provides them comfort that they're investing alongside very sophisticated capital.
Okay, so manager selection, risk management process, and investing alongside institutions.
Absolutely.
Crucial to match. Okay, thank you so much for sharing your insights with us today, Mark.
You're welcome, Sarah.
If you've enjoyed this interview, please subscribe to Livewire YouTube channel. Thank you for watching.